Boom. All right, what's going on, you guys? It's Royce Jacob, and in this video, I'm going to talk to you about why I believe that this current liquidity crisis that we're seeing in the economy is going to be rocket fuel for hard, solid money assets like Bitcoin and gold. Okay, so saying that this is completely my opinion is definitely a stretch, because I'm actually going to be reading an article that was written, or a blog post, I should say, that was written by Anthony Pompliano. He's a very well-known face and a reputable figure in cryptocurrency specifically, but in all of investing, I would say too. So this newsletter was released today. I'm gonna release this video a few days after it, just out of respect for the subscribers, because it is a paid newsletter. And yeah, again, I really like his pieces. I'll drop the link to this blog down below, and you can actually see it right here. It's pomp.substack.com if you do want to subscribe. Okay, so yeah, I'm just gonna read it out, give you kind of my personal take on it, and yeah, we'll just read along with me. Okay, so let's get into this. Okay, so the title of it is the liquidity crisis will drive monetary stimulus, which will force the adoption of sound money properties. Okay, to investors, we're watching history unfold. There will be books written about the events that are transpiring in financial markets right now. Every day feels like a month. Fear and panic are dominating the minds of most people. As I wrote earlier this week, though, like most things in my life, this too shall pass. Before we get into my thoughts about where we are, here's what happened in the last 24 hours or so. Okay, so I'm actually not going to go into these specifics, just because it will be out of date by the time I release this video, and you will know all this stuff. But I will go over this part, which kind of just frames the general economy right now. Okay, so this is just a small selection of the various developments. It can all be summed up with a simple framework. 1. COVID-19 has officially been labeled a pandemic by the World Health Organization. The necessary response requires social distancing and shutting down of large gatherings or various forms of economic activity. Okay, so yeah, bad. NBA games shut down, Coachella is stopped, music festivals, conferences, everything is down right now, which is obviously bad for the economy. 2, the virus is grinding economies around the world to a halt. Kind of everything I just mentioned. Economy is definitely slowing down. This is a very significant blow to our economy. And 3, the structural flaws in various markets are exposed when economies slow down, including too much leverage and lack of liquidity. Okay, so that's kind of getting into this liquidity crisis that we're getting into. Unfortunately, we're watching a liquidity crisis play out in real time. These liquidity issues are well understood structurally, but feel much worse than expected when they occur in reality. A liquidity crisis means that investors all rush to exit doors at the same time. But there are so many more sellers than buyers that investors actually have a hard time offloading their assets for cash. Quite literally, investors begin aggressively lowering the price that they are willing to accept for each asset in exchange for the cash, which they're desperately seeking right now. Okay, so yeah, right now, everyone's selling, nobody's buying. That is the liquidity crisis. When you want to sell and you're just willing to sell at almost any price just to get cash in hand, because right now cash is king. This is why you're seeing my asset with a liquid market tanking so hard right now. Additionally, the U.S. Treasury market, in parentheses, the most liquid market in the world, is experiencing incredible pain right now as well. So yeah, this is a volatility chart right here, and both of these are just volatility indexes. These can be seen as the VIX scale. That's also what it's known as, but yeah, that's a volatility index. Sorry, I'm stumbling over my words a little bit. But yeah, that's just how high volatility is right now. Volatility, if you're unsure what that means, is sharp rises and sharp falls. So crazy inclines, crazy declines. These two charts show the volatility is exploding, and there is increasing levels of illiquidity in the UST market. If this is happening in the most liquid markets, you can imagine how bad this is becoming in less liquid markets. Which brings me to assets like Bitcoin and gold. These assets have historically shown to be non-correlated, and B, serve as safe haven assets. That all changes during a liquidity crisis, though. In the short term, any asset that can be sold into a liquid market for cash is likely to be sold. Investors are incredibly insensitive to the price. They need cash so badly that they will make traditionally irrational decisions in order to optimize for liquidity. These sellers and liquidity seekers include retail investors, hedge funds, banks, and pretty much anyone else that has exposure to the financial markets. This type of imbalance in buyers and sellers also explains why the Fed is stepping into the repo markets, parentheses, overnight borrowing, with such significant size, recently increased to 175 billion. The statement that the Fed put out explains it well. And then, okay, so this is the statement that the Fed put out, obviously. Consistent with the FOMC directive to the desk, these operations are intended to ensure that the supply of reserves remains ample and to migrate the risk of money market pressures that could adversely affect policy implementation. They should help support smooth functioning of funding markets as market participants implement business resiliency plans in response to the coronavirus. If the Fed doesn't step in, there is even larger liquidity issues. Before we get off on a tangent, though, I want to get back to the sell-off in safe haven assets. Remember, the short-term optimization for investors is for liquidity. If an asset has a liquid market, the asset will be sold for cash. There's not an asset on the planet that is immune from this market dynamic. During the 2008 global financial crisis, gold dropped in price by more than 30%, leading into the depths of the real pain. This isn't because gold is a bad store of value or it has lost safe haven status after 5,000 years. It is because gold has a liquid market and investors needed liquidity over anything else. This is gold spot US dollar. This is just showing how panicked and volatile the gold market is during times of crisis. So this is 2008. You can see it dropped along with all the equities in the 2008 crisis, but after people realized they needed a hard store value, hard money, again like gold and Bitcoin, you can see it spiked up here right during the when did that start? Probably like August of 2008, and then going into 2009 is when it really took off. So I expect a similar thing to play out this year. Again, gold, Bitcoin just cratered along with everything else. But I expect midsummer, near the end of summer, we'll start to see those hard money assets really pick up some steam. Okay, even though gold fell 30% during the 6-month liquidity crisis, the asset still went from approximately $650 in 2006 to over $1,800 in 2011. So yeah, that's like a 3x over a few years, and then you can see it actually spiked up even more right there. Okay, why? Because people ran to gold when they feared that the United States would default on debt, that the U.S. monetary policy measures were a bad idea, and or that inflation was rising. Simply, gold served as a store value and safe haven asset over the full timeline of the crisis, but it succumbed to the liquidity crisis during the worst 6 months. This is what I believe is happening to Bitcoin right now. Bitcoin has a liquid market. So many people who are holding it will sell it for cash because they need liquidity. In fact, most of them have already sold the asset over the last week, which is why we have seen such significant drop in Bitcoin's price. The weak hands and or those seeking liquidity have most likely acted already. So it is unlikely that we will see continued sell-offs that cause massive price decreases from these levels. Approximately $6,000 prices of writing, and just now it tanked to I think $4,800. So it's bloody out there, guys. Be careful. This doesn't guarantee that Bitcoin's price won't go lower for a short period of time, but it does mean that most of the people who want liquidity have likely already sold. This then brings us to the next stage in how this crisis probably plays out: holders of last resort and the safe haven status. These are a group of people, mostly individuals, who believe very strongly in the concept of sound money, Bitcoin and gold. These people have spent the time to educate themselves on the technical structure, monetary policy, and potential benefits of Bitcoin. They're convinced that Bitcoin's sound money properties are superior to any form of money, regardless of Bitcoin's price movements. Regardless of price movements in the USD exchange value, the holders of last resort will not sell their Bitcoin. They're strong hands. They can't be shaken out of their belief. In fact, they're likely to be buying Bitcoin on these large price drops rather than selling. They're exchanging USD for Bitcoin right now. And you guys, that's exactly what I'm going to do right now. If you're in the space, or if you're Bitcoin specifically, I have to imagine you're playing the long game. I hope you are, because that is the safest way to play this game. It is a very volatile game, but if you believe in the long term, it will play out. If you do believe in the technicals and just the concept of sound money overall. I am one of the strong hands, and I exchanged more of my fiat currency into Bitcoin this morning. Yeah, so same here. Now the question shifts from who's still holding Bitcoin to what happens to Bitcoin over the next few months/years. This is where I get really excited. I get excited because Bitcoin was built for this scenario. It is the hardest money the world has ever seen. It is provably scarce. It was difficult and expensive to produce. And the monetary policy is programmatic and transparent. These things are important for any asset, but they become exponentially more important when we enter times like we're about to enter. While the liquidity crisis is occurring in traditional markets and asset prices are in a free fall, the US government will feel the need to step in to save the average person. The legacy system is not built on free market capitalism, but rather a watered-down version that relies on large centralized institutions and governments to step in during times of uncertainty and fear. As we have discussed previously, central banks and governments have two tools at their disposal: interest rate cuts and quantitative easing. We have seen the Fed Reserve cut rates consistently over the last year, including a recent 50 basis point emergency rate cut in the last 2 weeks. It wouldn't surprise me to see further rate cuts in the next 6 to 8 weeks. My guess is that we will see rates at least hit 0.25%, with a high likelihood that they hit 0%, which is insane when you're considering that this is the United States. It is also possible that the United States will enter negative interest rate land, but there is a religious aspect to a negative interest rates, which suggests that they will do everything in their power to avoid negative rates. So while rates are falling aggressively, the decision on when to shoot the other bullet, quantitative easing, becomes a focus. The Fed has already expanded their balance sheet by about $400 billion over the last few months, but they continue to say that it is not quantitative easing. Rather than argue semantics, it is important to understand that we have not likely seen anything like what they're going to have to do here. My best guess is that we will see at least $1 trillion in total quantitative easing by the time this crisis is over. Anything less than that will probably not be enough to have an intended impact. Think about that for a second. $1 trillion that is printed. Again, so that's what they're going to have to do to save kind of this economy, just because there's so many businesses struggling. Everyone's struggling right now, and they're just going to have to pump that money into the economy to keep everything somewhat afloat, or that's at least the intention, is to keep everything afloat. When the government prints this amount of money, they're injecting liquidity into the system, but they're also reminding people that the US dollar is not sound money. They're increasing the risk levels of inflation, and many will argue that the government is even illegally stealing the wealth of the bottom 50% of Americans when they print so much money. Again, yeah, that is why the US dollar, if you're not familiar with inflation, is worth so much less than it was. Remember, like back in the day, I'm talking like early 1900s, you could buy, I should just say like $1 was worth $20 back then. So that's just how inflation works. Like, it's crazy. The interest rate cuts and quantitative easing is market manipulation. They're trying to bail out the economy. When they do this, investors have historically weathered the liquidity crisis and then sought out A, sound money, and B, safe haven assets. Both gold and Bitcoin should do incredibly well during this time period. But Bitcoin has one other aspect to it than gold: the upcoming supply shock, which is the Bitcoin halving in May 2020 of this year. And I'm actually going to release a video talking about why I personally believe Bitcoin is better than gold, and it's primarily because of this halving. But back to this. Right when Bitcoin is about to become super attractive to people because of the U.S. government central bank begin incredible monetary stimulus efforts, the digital asset is going to see the incoming supply cut in half. One of the scarcest assets in the world is about to become even more scarce. This would be the equivalent of investors seeking gold because of inflation, but half the gold mines in the world were shutting down at the same time. And that's a great way to picture it. The Bitcoin halving is similar to as if half of the gold mines in the world were just to be wiped off. I say this because it is important for people to understand what is happening in the short term liquidity crisis, while still understanding the structural components that are at play in the long term. Monetary stimulus simultaneous to Bitcoin halving. So again, it's kind of a double whammy there. You're gonna get this monetary stimulus by the Fed and by the U.S. government, and that as well as the Bitcoin halving should really open some eyes to Bitcoin as hard money. I've been writing about this setup for almost a year now. It always had a 60 to 80% chance of happening in my mind. The big unknown was how long the bull market in traditional assets could last. The COVID-19 pandemic has accelerated the need for monetary stimulus, which is now going to fall within 60 days of the Bitcoin halving. My confidence level that we will see monetary stimulus around the same time as the Bitcoin halving is now well over 95%. You couldn't have written a better script for the continued adoption of the decentralized digital currency. And yeah, guys, even though Bitcoin just tanked along with the rest of the crypto markets and honestly all equity markets, I think we will see this period of kind of consolidation and just fear. And again, everyone just wants liquidity right now. But once the dust settles, I think Bitcoin and gold are going to kill it, if I haven't gotten that point across enough in this video yet. Bitcoin price is down. This is what happens in a liquidity crisis. But understand what happens in the next sequence of a crisis, monetary stimulus. Sorry, I was thinking if I just read that now. Monetary stimulus has been relied on in order to stabilize traditional markets. This will greatly benefit Bitcoin and gold. Weak hands will sell during the liquidity crisis, which is simply a transfer of these safe haven assets to the strong hands, the holders of the last resort. So that's kind of just summing up everything he just said. Weak hands are exiting the market. Strong hands who really believe in the tech and know that this will succeed when everything that we just talked about actually takes place. So be strong hands, guys. You want to be the strong hands right now, even though it's hard. Losing money sucks, but you only lose when you give up. So just don't give up, all right? Be safe out there. There's a lot of volatility. Sometimes it is best just to walk away from your computer and breathe. Real talk. Other times it is important to read about what is happening to ensure you understand where we are and in the timeline, where we are in the timeline of these events. All right, yeah, guys. So again, I just wanted to share this because I read it this morning and I believe that it was a really good read, and it really. I'm a big fan of this guy. I read all of his newsletters, so a lot of this isn't surprising to me, but I really wanted to share it with you guys because this is solid information, in my opinion. This time is not different. Liquidity crises have happened before. They will happen again. Monetary stimulus has driven investors to safe haven assets with sound money properties before. They will do it again many more times in the future. Welcome to market cycles if you have not been here before. All right, so this is in a sense, it's history repeating itself. This is very similar to 2008, honestly, if not a little worse. But that's the perfect example, just looking at those '08 charts and previous recession depression charts and seeing how safe haven assets like gold works. And once people, again, become more educated on Bitcoin and the tech behind it, the halving, etc., they will understand the sound money properties of it and flock to that as well as gold. History is transparent right now. Liquidity is dried up. Those that remain unfazed by the short-term pain are usually the ones who avoid making bad decisions. I can't believe we're getting the opportunity to live through this period in time. Thankfully, we have a parachute with us this time around. All right, Pomp. Again, you guys check out Pomp. He has a podcast too called Off the Chain. Great listens, especially if you're interested in investing. He's a cool dude too. He's definitely not a suit by any means, so it's easy to listen to. He's very good at articulating his points in a simple way, and he's one of my favorite people in the space personally. So again, pomp.substack.com if you want to check him out. And I really hope you guys appreciated this video, or I really appreciate you guys watching. I hope you guys got some value out of this video. I appreciate Pomp for giving me this and letting me share it with, not letting me, but I'm just sharing it with you guys because, again, I thought it was really valuable. And just let me know what you guys think about this, what your kind of investment plan of attack is for this impending recession, and not even a recession, but just the understanding that pumping US dollars into the economy will not work. It has no longevity. It's worked up until now. We've had a great system, but this is a black swan event. And it will really open people's eyes to how much the government's ability just to pump money into the economy affects your dollar, right? And you want hard money that will likely gain in value over time. Instead, it is deflationary. You want deflationary assets as opposed to inflationary assets. So Bitcoin is deflationary. The US dollar is inflationary. Okay, so again, let me know what you guys think. What's your plan of attack, and or just anything you guys want to talk about. I respond to all the comments. I don't get too many, but so I guess it makes it very easy to respond. But I always like talking to you guys, so drop a comment below. Just chop it up, and I'd appreciate it if you liked and subscribe too if you want to see more of this type of content. So, I appreciate you guys for the last time, and until next time, guys. Peace.